There's probably been a moment in your real estate career where you asked yourself, how the heck do real estate taxes work? How do short-term rental taxes work? How do rental arbitrage taxes work? And I've got good news for you. I have never been able to answer these questions on the channel because I'm not a CPA, but I have brought in reinforcements to walk you through the concept of real estate and short-term rental taxes. We cover everything. And if you're a short-term rental owner now or you're about to buy a property, then I highly encourage you to stick around until the very end of the video because we talk about how you can lower your tax bill by not just thousands, but tens of thousands, or if you're like me and so many of my other real estate friends, hundreds of thousands of dollars in taxes. Get a pen, get some paper, take notes, because I am about to help you save so much money in taxes. And if you're saving and keeping that money in your pocket and not paying it to Uncle Sam, then guess what? You're making money. And I'm gonna help you do that today 100% for free. Boop! Oop, accidentally touched the lens. Boop! Mitchell Baldridge, welcome to the Raw Built channel. Welcome back, really.
Thank you. Excited to be back.
I'm excited for you to be back too, because people ask me a lot of questions about real estate taxes that I both am not qualified for, because I don't know if you know this, I'm not a CPA, and I don't know the answer to.
Good.
You know all the answers.
I am a CPA, and I know enough, hopefully.
And you're the owner of Baldridge CPA as well.
Yep.
Most importantly, a co-owner of STR COSEG, which is our cost segregation company that focuses on helping short-term rental owners save tens of thousands of dollars, or in my case, hundreds of thousands of dollars in taxes.
Yep.
It's a beautiful thing.
It's wonderful. So we'll get all the way through it today.
So I think most people in my audience are coming from two specific camps. It's a lot of short-term rental operators. And within the short-term rental space, the two business types are basically rental arbitrage and ownership.
Yep.
And so the difference between both of these are rental arbitrage, you go to a landlord, you pitch them on the idea of renting their place and then subleasing it back on Airbnb. So if the landlord is charging me $1,500 a month, I want to make more than that on Airbnb, and I get to capture that delta.
Or if you're a real savage, you don't even tell the landlord, right? Is that how
No,
we do?
you don't do that. You don't do that. Back in 2015, I think that's what a lot of people did. But today, you got to get the permission if you want to run a legitimate business, which is what this video is all about.
Yep.
Category number 2 is ownership. All right, and this is basically where you go and you buy a house, and then you furnish it and you list it on Airbnb. And instead of paying a rent to a landlord, you're paying a mortgage to the bank.
Sure.
You own it, and hopefully you make more than what your mortgage is.
Yep.
So I think the main question that most people are going to have is, how do write-offs work? And what are the write-off differences between the arbitrage model and the ownership model? Can you talk about that for a little bit?
Yeah, look, the way you framed it is awesome, because you have this arbitrage business, and then if you go and own it, you're basically just arbitraging from yourself. You become your own landlord. So let's think about these as two different businesses in that sense of, like, you're going to run an arbitrage business no matter what. It's basically just who is the property owner. And an arbitrage business is really a hotel management company, or it's like any other business where, like you just said, the rent's $1,500. I'm going to try to get as much as I can as far as gross rents from third parties. I'm going to pay Airbnb their cut. I'm going to pay my rent. I'm going to pay my utilities. I'm going to pay my cleaners. I'm going to pay, internet and whatever I got to do. And then I have to furnish the whole thing. Well, these are all just like very concrete write-offs that are in your business plan of how to run this arbitrage business, right?
So basically any expense that you have in the arbitrage business, cleaners, utilities, furniture, repairs, maintenance, all that type of stuff is a write-off?
Yeah, certainly. And, we'll talk a lot about bonus depreciation, but, all the furniture you buy is either kind of like inexpensive enough to fall under the safe harbor to just be able to write off immediately, or is 7-year or 5-year property that you can just bonus depreciate. So, like, everything you outlay to set up, outfit, and operate this unit is write-offable. The other cool thing about kind of any business, like owning a small business is the best tax deal in America. You have all these expenses in your life you have your home internet, you have your automobile, you have your cell phone, you have your, meals and education and training and people are learning and growing and attending events and all that stuff. Well, now part of that becomes applicable to the broader business you're building. So now you have this revenue source and you have this activity to take other expenses that already exist in your life and kind of pull them into the business category.
Nice. Okay. So that's on the arbitrage side.
Yep.
All of your basic expenses, for the most part, seems like you can write off. There's some things in life that you can also pull in.
Start to pull in.
Like a cell phone bill, for example.
Yeah. Like I worked at a CPA firm before I went out on my own. They didn't pay me for my cell phone. I used my cell phone and just paid it after tax. I would make money, I would pay tax, and then I would pay my cell phone bill. Well, when I went out to business on my own, now I make money, I pay my cell phone bill, and then I pay tax. So
that's a difference, right?
37%. So,
yeah. Okay.
You know, and so that all starts to add up. And as you grow your business, you can kind of slip more of that stuff in or fit more of that stuff in as bona fide business expenses. But that's in a nutshell how, whether you're running a gelato shop or you're running an Airbnb arbitrage or a CPA firm, it's like money comes in the door, expenses go out, what's left you pay taxes on.
So I think I understand for the most part the tax situation with an arbitrage business. What about ownership? What applies to that? Is it like very different write-offs? How does that work?
Real estate also has a unique property in that there's this thing called depreciation. So depreciation is a paper loss, right? Or like it doesn't cost you cash, at least not in the short term, in the same way that the government will allow you to take deductions. So
really fast.
Yeah.
Just can you explain very simply what do you mean by paper loss?
So paper loss, you get this loss year one, you get this deduction year one, but you didn't really lose money. It didn't cost you cash. And you bought this asset that now you're going to make money over time. So it's this strange thing that doesn't really exist in people's lives very much, except for a couple of odd circumstances like this. There's not many ways for folks to go out there and create paper losses in their life like this.
So a quick example would be, just so I understand it.
Yeah.
I depreciate my house in year one, and let's just say the depreciation is $15,000.
Sure.
But I made a profit of $5,000.
Sure. You have $5,000 of cash in your pocket at the end of the year that you didn't have at the beginning of the year, but you're taking $15,000 of depreciation, and so you get to write on your tax return that you lost $10,000, even though you made $5,000 in cash.
Basically meaning that you don't have to actually pay taxes on the $5,000.
That's right. And so depreciation's real. Over time, all your stuff will break and you'll have to replace it. But the way that the tax system gives you credit for depreciation, they front load a lot of it today. And we'll talk a lot more about that, you know.
Oh, hey, really quick, just a friendly reminder that HostCon is happening October 28th through the 30th here in Houston, Texas. It's my short-term rental focused conference. If you get your tickets right now, you can still get early bird pricing, which I think is currently 50% off. And I have the most insane lineup of all time. Like, I'm genuinely nervous I'm not gonna be able to top this lineup next year, ranging from Pace Morby, the creative finance king, to Avery Carl, the vacation market queen, and so many other amazing speakers. So if you're ready to come to Houston and hang out with me and hundreds, and I'm talking about hundreds of other short-term rental operators, then go to hostcon.com or click the link in the description down below to lock down your early bird tickets. All right, now back to the video. So basically, to sum this up, arbitrage and typical business write-offs really pale in comparison to not just real estate write-offs, but we're gonna get into this at the end of the video, which is mind-blowing, so definitely stick around. But the short-term rental loophole, which blows all of this out the water. If you are a short-term rental owner, if you are someone that wants to buy a short-term rental, it's perhaps the most important game-changing tax thing that you could do to build wealth for basically your entire life.
Yeah, certainly. I mean, real estate offers this leverage to normal people in the form of bank debt and these quick accelerated bonus depreciation opportunities to regular people that just aren't available anywhere else.
Got it. Okay.
And then short-term rentals in particular condense the entire opportunity down to a $200,000 house that a normal person could go buy. So it's the same principles of tax benefits of real estate that we all know, that there's these old guys have been doing real estate for 40 years and never paid tax. Well, what all of this does is shrinks this down into the everyman can kind of take advantage of this loophole available to the big bad evil real estate bros.
Okay, so we'll jump into that a little bit at the end of the episode, but for the purpose of like the paper loss side of things, because I know a lot of people at home are like, that. I mean, hold on, just get me back to paper losses. Like I want to lose $15,000 but actually keep $5,000 of profit. So how does the concept of paper loss, what does it actually mean tactically from a real estate perspective?
So in 2017, there was this new law that Congress passed called the Tax Cuts Jobs Act. And what that law did is took this concept that had existed for a very long time called bonus depreciation and made it much more widely accessible. They allowed you to take bonus depreciation on used property, and they took bonus depreciation to be 100% of all 5-year, 7-year, 15-year property. So what does that all mean, right? That means that this house that you bought is a bunch of component pieces. It's sidewalks and landscaping and bathrooms and windows and a roof and an air conditioning system. Well, you can depreciate a lot of that property year one, just like you can depreciate the furniture you buy. And so on average, 20 to 35% of this purchase price of a house is depreciable year one. So if I put 20% down to buy a $500,000 house, and then I get a 30% deduction year one, that means I put $100,000 down to get a $150,000 deduction year one. So it's bananas.
So it's almost, you're not just writing off, I mean, conceptually, you're not just writing off like the down payment amount, but you're also writing off like an additional $50,000 in that.
Yeah, example. I mean, and that's with 80% depreciation. That's a somewhat aggressive example, but that's not really like it happens commonly. We see it a lot with STR cost tags. So what happens out there is whether I get a $75,000 write-off or a $150,000 write-off, I get a huge chunk of this down payment written off year one, paper loss, right? That like, if I was arbitraging all day and now I'm arbitraging 15 units and I'm making all this money and I'm able to deduct kind of all this cash out there today, this thing out there just wipes out all that profit like that. You go buy one of these houses, you take your $100,000 profit and you write off $150,000, and that just wipes you out for the year.
So are you saying if you had arbitrage units, you go and you buy a house, it helps wipe it out?
Yeah, or it starts to apply to your kind of ordinary income as well. So this is just the kind of like, this is just dropping an atomic bomb on your whole business, where you take this paper loss and you can wipe out a ton of income.
So effectively, almost like, and again, I always say arbitrage is fine. I'm not against it. Get your arbitrage units up and running, but you're going to pay taxes on all that profit.
Yep.
Unless you just massively take losses, like you lose money in if you actually lose money, then you won't have to pay taxes. But if you're a good operator, if you subscribe to the Raw Built channel and you like it and you leave a comment about something you learned today, and you're good at it, you'll make money, you're going to pay profit on it. So one strategy to defer that profit would be, once you have a few up and running, keep that money, use it, reinvest it into a home that you can buy.
Yep.
And then hopefully depreciate that, write that off.
Yep.
To the point where it actually obliterates a lot of the tax that you were going to pay.
That's right. Or you take this and you apply it to your W-2 income job, which we'll talk about.
That gets very crazy too. So if you're a doctor, a lawyer, an accountant, anyone, if you're a high earner, right? Like I think any earner that pays taxes, this all applies to. Yep. But if you're a high earner, like a 6-figure earner, short-term rentals are how you stop paying taxes.
Bingo.
And people they don't listen to this. Like they're just like, yeah, I get it, but I don't want to do it. I'm like, why don't you want to save like $75,000 in taxes.
Well, like before we jumped on, I'm like yelling at you. I'm like, everyone's going to say taxes are boring, but this is it. This is the whole business right here. Like, this is why we're here right now, is because the tax savings of short-term rentals are bananas. Like, every one of your videos should be just about this.
I know, right? Yeah. So, and they will be, because it's tax season.
Yeah, exactly.
October's coming up. So you've just described the concept of free money. You basically get to accelerate your depreciation, take a huge loss, which is absolutely bonkers. Anybody can do this? Like, why isn't everybody doing this?
Sure. So this is the problem, and this is why short-term rentals are an opportunity, and why this is hard to do. Is in the 1980s, people figured this out. Like, these hedge fund guys were just buying building after building after building, depreciating them, writing them off, paying no tax, making millions of dollars. They figured out the secret, and so Congress went in and passed laws that effectively made rental income a passive loss category. So there are these different types of income. There's active income, passive income, capital gains income. And so they took the passive income, meaning I'm going to write a check into something and not work in it. Mm-hmm. And they took that entire category of income and made it so that you cannot deduct passive losses against active income. So I can't take my W-2 income and my real estate losses and net them together unless I'm a real estate pro. And so becoming a real estate pro means I work 750 hours for myself in real estate, and I spend more than half my time working in real estate. So
that's a lot of time.
Yeah.
750 hours. I mean, that's significant.
If I'm an endodontist that works 3,000 hours a year, putting caps on teeth or whatever they do, I can't go.
I was going to ask, what the heck is an endodontist? All right. I thought you were saying a dinosaur.
Yeah.
If I'm a dinosaur.
Okay,
got it.
No, if I'm a doctor or a dentist and I have a practice and I work in my practice, I can't argue that I spend more than half my time working in real estate. It's just impossible.
Because the typical full-time hours for somebody in a year is like 2,000 or 2,050 or something like that.
Yep.
Yeah.
And so, then you have to go spend another 2,000 in real estate. That's hard to do. So a few ways out of this.
Wait, hold on. I thought you said 750. So it's either 750
and more than half your time.
Got it. Okay. So if you are a full-time worker, then you have to spend you have to work 4,000 hours a year.
Yep. So,
wow.
So there one thing people do is they marry a real estate pro, and we're actually announcing that we're going to start an online dating app for to match
real estate pros only.
Real estate pros only, fans. And then
look at you with the jokes. Did you write that before you got here? That's good. I like that.
I had that locked and loaded. Yeah. But no, so that's our next big venture. But no, so marry a real estate pro, and you get anointed with that status. So that's one thing folks do. But you say, I'm a doctor.
It's a great loophole. Just marry someone that's a real estate pro.
It can be expensive.
Yeah.
But but I'm a doctor and my wife's a lawyer and we both have big jobs. Well, there's no way that we're going to get real estate pro status.
You got me all excited, that anybody could do this. Yeah. That anybody could just do a cost segregation report, and then they can't.
Yeah, so I pulled the rug out from underneath.
Pulled the rug out from it, but please place it back under my feet.
Okay, so then enter the short-term rental loophole.
Yeah. I've been waiting for the. I know. I'm just like throwing you all the softballs here because I'm just like so excited to talk about the short-term rental loophole.
So the STR loophole. And we talked about this last time, and we're going to talk about it more.
And by the way, if you have not seen that video, go watch that video. It's on the channel. Caleb's got a little flashy graphic that's like, it's like right here. Click it after you watch this. It'll get in depth on this even more. But we are going to give you the fundamentals here, the condensed version of why this is a game-changing real estate strategy.
So we've been talking about the Arbitrage management company and wrapped around the kind of real estate ownership company. And that's what an STR is the same thing. If I put my accounting firm into a building, well, that building would be incidental to my accounting business, meaning I got to go somewhere. I'm either going to rent some office space or I'm going to buy my own, piece of real estate to house my practice in. Well, an STR business is the same thing. It's an active hospitality business that happens to have some real estate that it operates out of. So the government doesn't call that passive income. That is not rental income, or that is not a rental activity loss. That is an active business losing money. So you take the best thing.
Losing money on paper. Yeah, that's right.
So yeah, you take the best thing, which is I have an active management business that makes money, and then you take paper losses and easy access to kind of ordinary credit in normal banks that this is highly available, and you marry those two and you sprinkle a bunch of depreciation on top of it, and that becomes a ordinary active loss so long as you materially participate, meaning you have to manage this thing yourself, or you have to spend 100 hours or all of the time in the business, or 500 hours in aggregate amongst all of your STR properties. So,
and by the way, we actually have there's 7 ways to materially participate.
Sure.
Okay, so we have a free download, a PDF download that you can download in the description down below. It's 100% free. We actually write out all of the ways that you can materially participate in the management of your short-term rentals.
And as opposed to being $750 and more than half your time, you just have to meet one of the 6, or one of the 7.
One of the 7, okay.
Yeah, and so it's an easier threshold to materially participate in your business rather than do
the real estate
your entire life.
Yeah, because there's like
some woman that you don't even
that you met on our app.
You didn't even know her.
Yeah, because basically you can be a real estate pro 750 hours, which is very hard.
Yeah,
and you can't even do that if you're a full-time professional. Right. So in some other career, or you can self-manage your short-term rental and spend, you said 100 hours on said short-term rental, which is 2 hours a week, which is what you're going to spend anyway.
Yep.
And then you'd be able to do a cost segregation report and just obliterate your taxes.
So you have to spend 100 hours and more than anybody else in the business to materially participate. So yeah, that is why the STR loophole is kind of so powerful, is that it's just available to so many more people, and it's available at a smaller scale than, I got to go buy a $10 million building and spend all of my time and energy in real estate. It's like, I have to buy a house. I can figure out how to buy a house, and I can go get a loan to buy a house, and then I have to get on to Airbnb and run this thing, and it has to all pencil, and that's what you do.
Yeah,
right?
yeah. So,
but then you can take this big old paper loss that I just created. I mean, we talked about this. I took $100,000 and I created 150 of losses, and if I'm a doctor and my wife's a lawyer, and we have $400,000 as our kind of like family income, we can take 150 and layer it on top of that 400, and that's huge.
It's huge. Well, so we're batting around the concepts here. I think people get it, right? Like you can be a doctor making $300,000, and you can go buy a house, and you can manage it yourself as a doctor.
Sure.
And instead of having to be a real estate pro, you now get this amazing loophole that lets you depreciate at a very fast rate, and effectively knock out not only the profits that you make on the short-term rental side, but any of those losses that are outside of that carry into your W-2, lowering that tax. What I want to do is we actually have like an example of this. Like I want to actually put numbers to this, like a real life example, because this is like a report that we just ran for one of our clients, right? So we had a client that deferred $95,000 on his taxes this year using strcostseg.com. We'll change his name. We'll call him Dan.
Hey, Dan.
Yeah. So the breakdown here is the purchase price plus of $860 plus the $268 of construction, but $200K was non-depreciable land. So that's one thing we want to say. You can't depreciate land. So he put 1.2 in roughly. He deducted about $300,000.
25%. That's good.
That is good. That is good. And
again, that idea of like.
Oh, and then he received that at an 80% depreciation this year.
Yep.
So $298,000 is effectively what he was able to write off So he was in the 32% tax bracket.
Yep.
Because of that, he was able to save $95,000 with the cost segregation report.
So
that's crazy, man.
Again, like
that's a lot.
$1.2 million house, he got 25% deduction. So like you could go buy a $1.2 million house with 25% down, and you would basically be able to take your down payment and deduct it and write off $100K on your taxes.
Yeah, that's crazy.
That's not bad.
Yeah, or he could do none of that and just pay $95,000, not have the real estate that appreciates over 30 years, pay the $95,000 in taxes that he was going to pay.
So these are the options. Is he took $250, or I guess he takes $300 to go buy this house and saves $95, or he can just pay the $95,
and keep $200K or whatever.
Keep $200K, but then he won't have a house. And
right.
He won't have the
that goes up.
asset, and he won't have the optionality and the ability to kind of like grow from there. So
yeah, so imagine doing that like every single year for 5 years. If you could always save $95,000 on your taxes, and in 5 years it'd be like almost $500,000, which is like makes me want to vomit. That's how much that's how much someone would pay over 5 years.
Well, and there are a lot of, I mean, it's crazy, but yeah, there are people who make $600,000 who literally, if you can, he's in the 32% tax bracket, so he's somewhere in that range if he's married, and it's kind of, he can go take half of his income every year and wipe out a ton of tax and go, compound and buy something year over year over year. And you look up, and in 5 years he'd have, almost $10 million of property, and assuming it's kind of going up, and you build a lot of wealth that way. I see a lot of people that come in who have like done this just for a really long time, and you go, holy smokes, man, you have $100 million of real estate. That's crazy. And they just go, well, I just did it.
Yeah, consistently.
I just did it for 30 years, and I looked up, and
it was all paid off.
It was all paid off.
And you got to write all of it off for the most part, all of your down payment, and you get to pass it on to your family.
I've seen more people with just like 50 rent houses because they were listening to Bigger Pockets in 2012. I don't know. It's
a small podcast on the real estate side.
Tiny little podcast.
I hear the host is a hack.
One of them's good, but the other one.
Yeah. The guy with the hair, weirdo guy.
Yeah. So, I mean, but just people who followed that 1% rule and just were buying things and just never stopped buying. I mean, it's been a good run.
It has. And that, my friends, is cost segregation in a nutshell. Easy, right? Like we got it.
Simple.
Listen, we're trying to break this down as simple as possible, but I really think it is the greatest opportunity in real estate to save money, to build wealth, so if you're saving money, you're making money. That's how I feel about it.
Yep.
So if you want a cost segregation report, head on over to strcostseg.com. We just got through our first round of beta users, which is crazy. We've saved people millions. We've helped people defer millions of dollars in taxes, which is love it. Let's not give those taxes away. And we want to help you save.
One thing worth noting, if you've placed a property in service all the way back to late 2017, we can help you.
Yeah, so it's even better that way, right? Because you'll get the 100%
versus the 80% wimpy 2023 depreciation.
It's going to be worth it really for the next like 3 or 4 years, no doubt. And then even past then, I think it'll probably be juiced by, I think it'll be juiced by the government. I think the government will reinstate it back to where it was.
Also, like, not to brag, but the price point of what we do really makes it available. And
it's true.
We
are
when you go through the process,
giving it away.
You get the payback ratio right at the front before you commit to anything.
So go to strcostseg.com, enter in your address. It's all free. You can all do it. It will literally give you a ballpark range of how much money you will lower your tax bill by. And you'll get to see it. You'll get to, before you have to pay, before you have to do anything, you'll see that nice, beautiful, big number, hopefully, for you. And you'll say, this makes a lot of sense. I want to save this. This year, I mean, I'm looking at a property right now that will hopefully save me about $500-600K in taxes.
Let's go.
So excited. The cool thing is, even if you take losses and you have leftover losses and you've obliterated all of your taxes for this year, you get to roll them over to the next year.
Yep.
And then you knock out those taxes and you do it over and over and over again. You build generational wealth. Thanks for being on the show, man.
Thank you, Rob.
Appreciate it.
This is fun.
Yeah. Catch you guys on the next episode of Rob Bill. And if you found value, don't forget to like, because it helps the channel. Okay? Helps me. Thank you. Bye.